the end of 2019, Valerie Corporation reported a deferred tax liability of $41,000. At the end of 2020, the company had $241,000 of temporary differences related to property, plant, and equipment. Depreciation expense on this property, plant, and equipment has been lower than the CCA claimed on Valerie's income tax returns. The resulting future taxable amounts are as follows. We're given some numbers there. The tax rate enacted as of the beginning of 2019 are as follows: $31,000 for 2019 and 2020, 30% for 2020 and 2022, and 25% for 2023 and later. Taxable income is expected in all future years. And we're asked to calculate the deferred tax account balance at December 31st, 2020. Okay, so let's take a look at what that looks like. So what we need to do to calculate the deferred tax balance at the end of 2020 is we need to have future taxable amounts. So what's the impact on tax in the future? And we're going to run the year across the top here. So we're going to have the year, which is going to be 2020, 2021, 2022, 2023, 2024, and total. The reason we're doing this is because we're trying to figure out in the future what's going to happen for tax so we can figure out what the balance is at 2020. So our future taxable amounts are going to be, you can see that the resulting future taxable amounts are as follows. So they've given us the future taxable amounts on the PP&E of this difference. So we know we're going to have a future taxable amount of $78,000 in 2021, $62,000 in 2022, $55,000 2023, and $46,000 in 2024. So my sum here should get me back to that $241,000, which is the same sum they gave me in the question. Okay, yes it does. So we know we've got the right amounts. Now we need to run the enacted tax rates. We've got different tax rates here. So we're told in 2021, it's going to be 30%. In 2022, 30%. 2023, 25%. And later it says, so 2025. Okay, so then now my deferred tax liability is going to be the future taxable amount. We know that these are all going to be taxable amounts. So these are all liabilities because they're all representative of future taxes. And those are my deferred tax liabilities. So then now if I run my sum, my total deferred tax liability for 2020 is $67,250. B says, prepare the journal entry for Valerie to record deferred taxes for 2020. Okay, so my journal entry to record taxes is going to be so calculating the journal entry to record the deferred tax liability is an interesting one because deferred tax is actually a balance sheet approach. So these are deferred tax amounts or deferred taxes in the future, but our deferred tax liability needs to be based on the balance sheet. So normally we would compare the net book value versus the UCC for PP&E differences. Net book value versus UCC would give us our deferred tax journal entry. However, here we don't have that. Well, all that we know is that in the future, there's a difference between accounting and tax for this $241,000. This amount here is going to represent that difference. So that's the only number that we have to work with in terms of the net book value versus the UCC, because that's our difference between accounting and tax. So what we're going to use is this $241,000, which is the difference between UCC and tax. We're going to use the tax rate for each year. And then we're going to get our deferred tax liability. So our deferred tax liability here, let's try using, is going to give me a difference of, normally we would take this amount and the difference and multiply by the tax rate to get the difference. We don't know because there's several rates, but But the difference here is going to be this $67,250. So that's going to be our deferred tax liability. So here we're going to have our deferred tax liability. So remember that when we make entries to deferred tax liability, we need to make sure that we're looking at the change in the account. So deferred tax liability for December 31st, 2020, we want it to be this number. The opening deferred tax liability, do we have an opening balance? It says that at the end of 2020, Valerie Corporation reported a deferred tax liability of $41,000. So yes, we do. We have a $41,000 opening balance. So then the change required for the journal entry is going to be $67,250, which is what we want, minus $41,000. So we need to actually make an entry for $26,250 because this is a balance sheet account. So if we have this in the balance sheet account and now we increase it by $26,250, then we'll end up with a balance of $67,250. So we're going to record debit deferred tax expense and credit deferred tax liability. So now we're increasing this amount and we're going to have this going through, and that will give us the deferred tax liability of $67,250 that we need. He says early in 2021, after the 2020 financial statements were released, new tax rates were enacted. Prepare the journal entry to recognize the change in tax rates. Okay, we can do that. So let's take this same schedule that we have here. So let's go see change in tax rates. So we're going to have the same schedule. Now our tax rates are going to change. So what happened? So the tax rates were enacted 29% for 2021 and 27% for later. Okay, so that's the change in tax rates. So you can see how these rates here are different than the rates we originally had in our table. So there's been a change in tax rates. So what does the company do when there's a change in tax rates? They've already issued their financial statements. So obviously they won't have to make an adjustment to this 2020 statements, but they will need to make an entry when the change in tax rates is enacted. So whatever date that is, it doesn't have to be a year-end date. So you can see that this is automatically calculated through just because I have formulas. So my taxable amounts haven't changed. All that's changed is the tax rate, and that's going to change my deferred tax liability. So I'm going to need to make an entry for that. So what was my deferred tax liability? Deferred tax liability after change in rates. So I want my deferred tax liability now to be $66,630, which is just this total. It's the sum of the new amounts with the new tax rates applied. My existing DTL or deferred tax liability is this amount up here. Remember how we had adjusted the account so we could get to this $67,250. So the change required is going to be the difference between these two things. So it makes sense. Our future tax liability should go down because the rates have moved, so we have to pay less future tax. So we're going to make an adjustment for $620. That's saying that, listen, we actually only have to pay, we're going to pay $620 less than we thought in the future because the tax rates went down. So now we're decreasing the deferred tax liability. So remember when we increased it, we went debit deferred tax expense, credit deferred tax liability. Now we need to decrease the deferred tax liability. So debiting a liability decreases it, 620. And we're going to put this through our income statement as deferred tax benefit. Deferred tax benefit and deferred tax expense are interchangeable. They're two P&L accounts. So we're having a favorable impact on our income statement for that $620. And that takes us through the completion of this question.